Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Before we get into today's episode, don't forget, Trish Regan is now a part of the Stansberry family. Check out her podcast, American Consequences with Trish Regan. The link will be in the description of this episode. Today, we will talk with Jack Schwager. I'm really looking forward to this. That Jack Schwager, yes, that guy, the guy who wrote all those wonderful Market Wizards books, he's here. In the mailbag, it was kind of a light week this week. More comments than questions, but we do have one very good question from listener Thomas Y, and I'll show you an easy way to track the data he's asking about. In my opening rant this week, I'll just talk a little bit more about the real McCoy stock market bubble we're living in right now. That and more right now on the Stansberry Investor Hour. A real McCoy stock market bubble. That's what we're living through right this minute, December 2020. And those words, the real McCoy stock market bubble, that's not just me, okay? That's Jeremy Grantham recently on CNBC. And he says we're living through, I think it was the third real McCoy stock market bubble of his career. And that means a lot coming from Grantham because his firm, GMO, has studied stock market bubbles. They've studied like a couple dozen of them. So they know stock market bubbles inside out, upside down, and backwards. And they've tended to perform well throughout them. And his firm does these 7-year forecasts. Large cap U.S. stocks for the next 7 years, negative returns, negative annualized returns for the next 7 years. Small cap stocks, U.S. stocks, negative annualized returns. Large cap international stocks, negative annualized returns. Most bond classes, negative annualized returns. The only thing that was attractive was like emerging market debt. No, I'm sorry, emerging market equity. Emerging market debt was still positive. That wasn't very attractive. But emerging market equity, I think, was like the value end of it, right? Emerging market value was like they were forecasting 9% a year for the next 7 years compared to what you can expect from the rest of the market. Not too shabby. Okay, and then John Hussman just came out. John Hussman from Hussman Funds. We quote his work frequently because he does the best work on valuing the overall stock market and relating it to the history of the stock market's performance over the last century, right? So he's the guy. If you think the market is extremely overvalued, he's the guy to check with. And right now, he says it's more expensive than it's ever been any time in history, bar none, including 1929, March of 2000, anything. And his forecast for the S&P 500 for the next 12 years is like negative 3.6% a year. Negative 3.6% a year. Holy crap. That's terrible. And his forecast for like a portfolio, he does like a 60-30-10 portfolio. 60% S&P 500, 30% long-term treasuries, 10% T-bills. Short-term treasuries. And that is like negative 1.7% a year for the next 12 years forecast based on today's valuations. And valuation, you can say, well, it doesn't matter, or, it's a terrible timing mechanism. You won't get any disagreement from me on the timing mechanism, but over the long term, it's the force of gravity. I mean, that was one of the points Grantham made when he was on CNBC. He was like, you can't change the fact that your return depends on how much you're paying for the cash flows you get. Full stop, right? That's what investing is. And during times like this, people seem to think investing is something else. It's like playing the lotto or something. And we've just lived through, if you look on like Bloomberg or Wall Street Journal or something, there are articles. We've just lived through the greatest November in the stock market since 1928, right? Since 1928. It was the greatest month in the stock market since like early 1928. And then there's like the put call ratio. If you want to know how crazy people are, how crazy the speculators are, you look at the put call ratio, lower than it's ever been in history. So that means that more people are buying call options, versus put options than ever before. They're buying calls, they're speculating wildly. They're buying calls as, like I said, lottery tickets. So we've got rampant speculation in the most expensive market in history. You tell me what happens. Maybe it doesn't happen next week or next month or even next quarter. But, well, I'll tell you what. I'm going to keep the rant really short this week because the next thought out of my mouth has got to be my quote of the week after I just said everything I just said. And this comes from none other than the great Bernard Baruch, which is how they pronounced it in his day and age in the early 20th century. Bernard Baruch, from his autobiography, My Own Story, from the first volume. I didn't even know there was a second volume. I had to order it just yesterday. But he says, whatever men attempt, they seem driven to overdo. When hopes are soaring, I always repeat to myself, 2 + 2 still equals 4, and no one ever invented a way of getting something for nothing. When the outlook is steeped in pessimism, I always remind myself 2 + 2 still equals 4, and you can't keep mankind down for long. That's Bernard Baruch. That's where we are. We're at the people thinking they're getting something for nothing end of that, right? When hopes are soaring, I always remind myself, nobody ever invented a way of getting something for nothing. And that's what, when you see all these Robinhood traders and, all the call option buyers, they think it's easy money, right? So that they really do believe they're getting something for nothing, right? They don't think they don't understand the amount of risk they're taking. These are levered instruments, call options are. And a lot of the companies they're trading are either pure garbage, or even if they're not pure garbage, even if they're the greatest businesses in the world, they're more expensive than they've ever been before. And they don't get it, right? Their hopes are soaring. I think that's a great quote. I saw that like a week and a half ago. And I was like, this has got to be a quote of the week because, and things have just gotten more expensive since I first saw it. So that's the way it is. All right. That's all I want to say this week. I just want to I know I've said this before and said it recently. So I just wanted to reiterate it, get it back in front of you, because that's the way I am as an analyst, right? In the newsletter business, one way you could do this is every month you say something different. And you say something different month after month after month. Oh, and then one of your little predictions happens and you go back and you say, See that? I told you, when you might have said the opposite the next month after that, right? I don't do that. I don't do that at all. I assess the situation, and if it doesn't change, I don't change. And if it does change, I change, right? What did I say in early April of this year? I said, buy great businesses now, because the market fell 34% in world record time. Now we're back up to higher, more expensive than we were before the whole COVID thing. So I'm back to being really super cautious and outright bearish even. And you could say, but Dan, you were bearish in 2017. You're right. And I said the stock market is a lot riskier. But what have we said is the definition of risk? Risk is a wider range of potential outcomes. And what has happened since 2017? If you look at a chart of the S&P 500, it's a big wedge widening out in time. The range of outcomes, the actual range of outcomes, not the potential, the actual one was wider, indicating indeed I was right, because I said there was higher risk, and a higher range of actual outcomes is exactly what happened. So I'm gonna say I was right about that, even though the market is really still bumping up against new all-time highs here. I was right overall about the situation, even if, not being long and strong and buying all the dips, even though that was really the best thing to do. All right. Let us do it right now. Let's talk to the one and only Mr. Jack Schwager. My listeners know they need to secure their savings for the future, and after working with my friend and publisher Porter Stansberry for nearly 2 decades, I've seen him make one incredible investment call after another over the years. So that's why I wanted to recommend Porter's one critical move you must make with your money. You can get his full take on the subject by visiting www.newamericancurrency.com. Don't miss out. Okay, it's time for our interview today, and I'm really super excited about this one. We have the one and only Mr. Jack Schwager with us today. You probably recognize the name. Jack Schwager is a recognized industry expert in futures and hedge funds and the author of a number of widely acclaimed financial books. He is one of the founders of fundseeder.com, a platform designed to find undiscovered trading talent worldwide and connect unknown successful traders with sources of investment capital. Previously, Mr. Schwager was a partner in the Fortune Group, a London-based hedge fund advisory firm. His prior experience includes 22 years as director of futures research for some of Wall Street's leading firms, most recently Prudential Securities. Mr. Schwager has written extensively on the futures industry and great traders in all financial markets. He is perhaps best known for his best-selling series of interviews with the greatest hedge fund managers of the last 3 decades. Market Wizards, The New Market Wizards, Stock Market Wizards, Hedge Fund Market Wizards, and The Little Book of Market Wizards. If you have not read the Market Wizards book, you are missing something in your investment knowledge. Read them immediately. His other books include Market Sense and Nonsense, a compendium of investment misconceptions, and the 3-volume series Schwager on Futures, including volumes on fundamental analysis, technical analysis, and managed trading. He's also the author of Getting Started in Technical Analysis, part of John Wiley's popular Getting Started series. Jack Schwager, welcome to the program. Thank you for being here, sir.
Hey, thanks.
So I'm curious, Jack, when did this all start for you? How old were you when you first got interested in finance, and then when you first got interested in futures?
I was out of graduate school. I think I was about 22, 23. And my first job was, I had no idea about markets. I mean, nothing more than anybody would. Wasn't looking for a career in the markets. I didn't have a envision being a trader. None of that was part of my objective. All I was looking for was an analytical job related to economics, and I didn't know what that was going to be. And it turned out the first job that offer that I had that was decent was wasn't decent in terms of pay, but in terms of being an interesting entree to my first job was a position as a futures analyst for one of the brokerage firms. And that's how I got involved in markets. And of course, once you're an analyst, it's really a short step to being tempted to trade.
Mm-hmm. So, what does a novice beginning futures analyst even do?
Yeah, that's a good question. Especially when I came into I go back a while, so I think I started in 71.
Wow.
Yeah, so futures were really more of a backwater, I guess, or certainly, yeah, to some extent. But moreover, there wasn't much on it. So, I read what articles I could find. There really weren't any good books. I eventually ended up writing my own book because I didn't think there were, that's how I wrote my first book, Complete Guide to the Futures Markets, because I didn't think there was anything good out there. I just, did sort of, I started out as a fundamental analyst, so I was just doing my own economic type of research. And I didn't get moved to pick up on technical analysis. So I read on it, but I was just kind of skeptical. It wasn't until years later that I really got very serious about technical analysis. But in those early years, I was just doing fundamental analysis on the markets, and it was a purely creative process. It was just taking what analytical tools I had and learning just from, just watching the markets. And it was kind of ironic. I still remember to this day, I was 2 weeks into the job, and I got a call from one of the newspapers asking me to comment on a market. And I just thought it was immensely humorous that I, for a whole 2 weeks of knowledge, or experience in markets at all, was being asked as an expert advice. I still remember that to this day.
Yeah, I bet that gave you a real good feeling for the value of like talking head experts on TV for the rest of your career.
Well, I guess it made me realize, that what you hear isn't always, worth listening to, because I certainly probably wasn't at that point in time.
Right. Well, you were new meat. They were like, "Hey, we've never heard of Jack Schwager. We got to get him on the program."
They were
It's
just
funny.
asking. They were just trying to get something to write of why the market went up or down or whatever. I don't even remember which market it was. And,
Right.
yeah,
Yeah, it's interesting why markets go up and down. Isn't that a crazy thing? Every day, the market went up 0.5% because of this, and it went down 0.5% because of that, and it's all noise.
yeah. It's more than that. This is one of the great ironies. It's one of the things I point out in that book, Market Sense and Nonsense, is people kind of try to look to the news for why the market went up and down. They got it completely backwards. It's the market goes up or down, and unless there's really some development of consequence, which is usually not the case, uh, then people have to come up with some reason of why the market went up and down. They fit some reason, and that reason could have been there, all along, and the market went up that day and it went down other days, and that reason was still there. But they'll pull it out and say, well, the market went up because people started to pay attention to this or whatever. So it's just about, it doesn't tell you why the market went up and down. Actually, most of the gyrations in the market are based, well, the major trend is based on underlying driving fundamentals, whereas the daily gyrations, just that's not related to news most of the time. It's usually just the market fluctuating around its basic trend and reacting to being short-term oversold or overbought, things like that. It's not the news you read on typical financial papers of why the market was up and down is usually not the reason. And in fact, I even have pull in the book. I have an example where it was a Federal Reserve annual meeting, and the chairman sort of made some comments in the morning, and the markets were down, and the news was, well, the markets are disappointed Bernanke's comments, and it's sold off because of that. Then the same day, the market went up and closed higher, and I swear, the same news service, the market was up today because encouraged by Bernanke's comments. The same comments, nothing happened. The comments were made before the opening. When the market opened lower, it was why the market was down, and when the market closed higher, it was why the market was up. I mean, this happens all the time.
Yeah, it's funny. A couple weeks ago on the podcast, I covered two headlines that occurred within 24 hours of each other, totally opposite explanations for the same, or they were the identical explanation for opposite moves. It's just ridiculous. Yeah. And you can tell it's a big tell, isn't it? It's like they never tell you why the market's going to do what it's going to do tomorrow. It's always they're backfitting the story to what happened yesterday. It's sort of, why don't they ever tell me what's going to happen tomorrow?
Well, that's their job. Their job is to do that. And but by the way, in this new book, this is kind of an interesting, useful point, I think, for listeners. And one of the traders I interviewed, a fellow by the name of Jason Shapiro, he's a real contrarian trader. But one of the most useful things he said in that interview was his favorite word is despite. Despite. If you ever see the market went up today despite this news, he said that's a really bullish signal, because when they can't even explain, why the market up, and they have to explain it went up despite opposite news, that itself is telling you something. So it's kind of a related point that I think is worthwhile knowing.
Yeah, I thought you made a similar point. I want to say in the section, like your little narrative section right after the Peter Brandt interview, there was a section I thought where you had said, I could have this wrong. I could be confusing it with another part of the book, but it was like you were saying basically when people say, "Oh, it was the old Fed quantitative easing is going to, crash the market story," and people were saying that was a huge despite, right? Despite for years and years and years, and the thing just keeps going up and up and up.
Yeah.
Yeah, Peter's an interesting guy, isn't he? Peter Brandt. He's your first interview in the new book, Unknown Market Wizards.
Yeah, I know Peter. So he's the one person. Well, I knew well. I mean, a couple of other people I had met, but Peter I knew as a friend, and he just has great. And he's a futures trader. He trades stocks somewhat. So also, since he's just a futures trader, but his insights about markets and particularly about money management are really valuable. I mean, he's a true veteran. I mean, he's traded like 40 years, and although in two separate careers, he traded for like, I don't know, 16, 17 years, and then traded again, then stopped trading, went cold turkey for about 11 years, and then restarted again. Um, and his whole emphasis is that he's a chart. He trades on charts, but his real points are that's not the charts. Charts don't predict anything. It's just giving him useful points where to put on trades. But what really drives his results in terms of return to risk is his absolute risk management. And he has lots of comments and suggestions and advice about risk management, lots of different rules. Some that you kind of don't hear everywhere. Like he has one rule he calls his Friday rule, which is if he has any position on as of the Friday close, which is losing money, doesn't make a difference how much. If he's not ahead of the position by Friday's close, he'll get out. And he says that rule saved him a lot of money over the years. It's just one example, but he has lots of those types of rules. And I knew, I kind of knew since I knew him, I wanted to get him in the book, sort of preserve his, he's now, he's like, I think 72, 73. And I wanted to make sure I got an interview with him and captured his ideas for posterity. And that was actually a catalyst for writing this book. I sort of, wanted to have his interview. And we both lived in Colorado, about 2 hours apart. He was moving out of state. So that's what got me started. I figured, well, let me interview him before he moves. Ends up, he had moved by the time I got to interview him, but that's what got me started on the project.
Oh, cool. Yeah, that's an interesting interview because he comes right out and says long-term chart patterns don't work anymore. I mean, he says it in plain, clear English.
Yeah.
That kind of didn't surprise me, but it blew me away a little bit.
Well, this is from a man who has traded on charts all his life and profitably. But his thing is the charts don't, he emphasizes over and over, the charts don't predict anything. They don't, but what they are useful for is there are points at which, based on the pattern, there's a realistic shot that the market is going to go significantly one way or the other. And it's a higher probability point in time. It doesn't mean that prediction, if let's say it looks like the market, it's formed like, say, head and shoulders or whatever, that's completed, and it looks like it's ready to go, and he thinks the market's going higher. It doesn't mean that that's a reliable prediction this market's going up. It means that there's some reasonable probability that this might be a point where the market takes off. And if and he'll put a position on. Moreover, it has to be a point where he can define, it has to be a type of pattern where he can define a close point, a close stop point, which tells him he should be out. And so those are the points he looks for where there's a reasonable possibility it might be the beginning of a new swing. And he can take the trade and not risk too much. And if he's wrong, he's out. His typical loss on a trade is, I don't know, 0.25%, maybe 0.5% at most of his equity. So he's never risking. I think 0.25% is probably pretty close to what his average loss is on a trade. So it's not that the charts are predicting so much. It's that the charts provide an entry tool, a timing entry tool, that here's the spot where the return risk is favorable. That's what it does.
Right. And he puts the emphasis, like you said, it's the emphasis on risk management. And this is just a way to, it's like the charts are just a way to set that process in motion.
Exactly.
But it's really the risk management process that is key. And I have to say, if there's one theme from like the very first Market Wizards book all through, New Market Wizards, Stock Market Wizards, all of them, it's this, isn't it? It's risk management.
Yeah, and I beat people over the head in all the books with this that say, look, here are great traders. They've been enormously successful, and what they all say, I can think of only one exception. What they all say is that, hey, risk management is critical to your, succeeding as a trader, and moreover, most of them will emphasize that, hey, it's not my methodology so much as my risk management of why I've succeeded. So it's super important. And it's exactly the thing that particularly beginning traders tend to not appreciate or understand or want to deal with. And I think that's part of the thing is, risk management isn't particularly exciting. It's really a matter about how you're going to lose money, right? And it's not appealing, and there's nothing dramatically creative you can do with it. It's much sexier to try to figure out, hey, some great methodology to get in and out of trades that nobody else has figured out. That appeals to people, but they kind of ignore how critical the risk management part is. Because even if you come up with a good methodology, if you do not have good risk management, it's just a matter of time before you get carried out.
You're right. It's not very sexy, is it? But I would go farther than what you said, Jack. You said like, novice traders, they don't appreciate it. Isn't it true that novice traders, they seem to think the exact opposite? Like they think the opposite of what Peter Brandt was saying. They think that you got to know that chart pattern because that's going to predict how much money you're going to make. And those chart patterns have high predictive value. And if you can just find enough of them, you can be rich in no time. Right? I mean, they think the exact opposite of the way it really is.
That's probably true. That's probably true. And it's one of the things I find humorous is, Peter now, the book is called Unknown Market Wizards, and Peter is the one really known, well, somewhat known. He's not known in the investment community because he doesn't manage money, but he's known among traders because over the last few years, he's built up this big Twitter following, right? And it's humorous when I see this, like somebody will criticize him, why should anybody listen to Peter? He predicted the S&P was going down 1,000 points lower or whatever it might be, And he took a trade short the S&P 1,000 points lower, but you know what? He was out of that trade one day later at a 10-point loss. And he's been long 50 times since then. So it's like I say, it's humorous the way people react to this stuff.
It is humorous, and the reality. You know what the reality reminds me of? If you ever saw the film or the play Amadeus about Mozart.
Yeah.
And Mozart is portrayed as this kind of almost silly character.
Right.
And he at one point he says, I compose in my head and the rest is just scribbling and bibbling and bibbling and scribbling. And if you look at the reality of the great genius composer's life, you would see him just like sitting at a table scribbling all day. And it's very boring and it's nothing anyone would ever want to do with their life, And yet the narrative is we talk about what a genius he is and the creative process and all this stuff. And it's just so much drudgery to it. And I feel like trading is the same way.
Yeah, the boring thing, glad you used that word because thanks to Hollywood, people have this image of trading, they have an image of trading. What do you think trading is? It's a room full of people screaming at the top of their lungs, just super aggressive and, people
right.
losing fortunes, making fortunes, going crazy, tearing their hair out, jumping on a desk, throwing phones at the screen, or whatever. That's the image people have of trading. If you go watch actual really successful traders or a room where there are some really good traders, it's closer to a library than that Hollywood image. It's really more cerebral, focused, highly focused, really intensely focused. And there is no super excitement and stuff like that. That's actually very, very negative. And there's a quote by Alex Honnold, who's probably the world's greatest free climber. I think what he does is insane. For people who don't know who he is, he's this guy who, without protection, without ropes, but without even ropes for protection, will climb sheer cliffs like Yosemite, El Capitan, and there's a movie that he made. If you haven't seen it, extraordinary, worth seeing. But he's interviewed on 60 Minutes, and I'm watching it, and she asks him, "Do you ever get an adrenaline rush?" And he says, oh my God, no. I mean, if I get an adrenaline rush, something is drastically wrong. Everything needs to be slow and controlled." So I'm paraphrasing him here. And I sort of I put the pause button on the on the remote, ran and get a pad, replayed it, copied it for word, and I used that as the opening quote in, I think it was the Little Book of Market Wizards, because I thought it was so apropos for what trading really is. There should be no adrenaline rush. The idea is to get the emotions out of it. You want everything to be slow and controlled. And again, this is a type of thing that people get totally backwards. They think it's all about excitement, but if there's excitement, that's really not. Then you're doing something wrong.
Yeah, and one guy, I've only heard of these people in your book, Unknown Market Wizards. They really are unknown. I've only heard of Peter Brandt and John Netto. And you're talking about emotions. John Netto has a whole chapter in his book, Global Macro Edge. It's much later in the book. It's emotions are our greatest ally, not our biggest enemy. And he says, when I start to get too comfortable in a position, it makes me nervous.
Yeah,
That's complex emotional self-analysis.
it is.
When I get too comfortable, it makes me nervous.
And Neto, and in that particular interview, we have a little bit of because one piece of advice I've repeated in multiple books is this idea of trying to get emotions out of it. And Neto said, "Well, why would you want to do that?" And of course, my thing is because emotions interfere with clear thinking and objective, trading and stuff like that. But he takes it one step further. I mean, he doesn't. So we really don't have a disagreement. He agrees that type of emotion is detrimental, but he's kind of moved to the point where he's introspective enough that he can analyze his own emotions as an indicator of, when he's wrong. Like if he finds himself, like he says at one point where, let's say he's long gold and gold immediately goes up a bit and it looks like it's going to go much higher and he gets like this thing's going to the moon. And if he goes from that sort of like feeling 7 or 8 about the trade to being like a 10, there's no way this thing can lose, it's going right away. That's an indicator to him that there's a sure thing the market's going to first correct now before it goes higher. So he uses himself as a contrary indicator, but that's kind of sophisticated. For most people, just trying to eliminate emotions is the first step. Getting to a point where you can tap into your own emotions as a contrary indicator is a more complex thing that requires lots of experience.
Yeah, I'll say. Is there anybody, you've interviewed dozens of people for all these books over the years. Has anyone else ever spoken about emotions the way Netto does? I don't remember.
Not the way Netto does. No. I mean, it's come up a number of times in the framework of you don't want to let your emotions get in the way, and that's come up in many ways. For example, the idea of one trader saying, "Don't trade so large that fear influences your decisions." So if fear is playing any role, your position size is too large. I mean, that's an example of advice related to emotion, right? So, but the idea is to have your position size at a point where you don't have that particular emotion, namely fear. So, so this come up many times, but not the way Netto. Netto's kind of got a contrarian approach to it, is saying you don't want to exclude emotion because if you could tap into your own emotions as, again, I'm emphasizing the word here, as a contrary indicator. So when he uses emotions, it tells him that because he's so one way or another about a market, it's a sign that it's going to go the other way short term.
Yeah, don't try this at home, huh? I want to shift gears a little bit here because I just want to ask you two things. One is like, if you tell me about how much and what kind, if any, of your own trading you've done over the years, on the one hand, and then I also want to talk about fund seeder, and whichever one of those you want to talk about first is fine with me.
Yeah, so we'll go in order. So in my own trading, First of all, I should emphasize that I write about market wizards. I don't. I'm certainly not a market wizard. Uh, my own trading is net profitable for sure, but only because I've interviewed these people and I've kind of learned from the process myself. So I eat my own cooking, and that what I'm telling the the advice I'm giving in these books are advice I follow myself, and has to help me transform from being a loser to a winner. But not a I'm not a I'm just not naturally a good trader. I don't have any particular skill in trading like the people I interview do. Um, and it's never been a full-time avocation. It's always been kind of a hobby. I've usually had full-time endeavors, and so I would trade on the side. Just a hobby is probably the best way to describe it. And there are times where I'm so busy I don't have time to focus at all, and I don't trade. And there are times where I do trade. I have more time and I trade more. So it varies. Anyway, so that's my trading methodology is change. I start as a fundamentals, which for me, coming from an economic background, seemed natural, but it turned out it was the wrong approach for me, which I discovered over time. You have to find what works for you. I eventually ended up with technical analysis. I went for a period where I did systematic trading because I didn't want to have the emotion of having to make decisions. I discovered that for myself, systematic trading was actually more emotional because you have to be willing to tolerate drawdowns and rely and just believe in the system. And I was uncomfortable with the types of drawdowns you could get with systematic trading, particularly trend following. So I eventually just ended up doing chart-oriented trading, which is when I trade these days. That's what I do. And basically, I would say I pick chart points. I could be going against the trend or with the trend. I do both. I probably go against the trend more, not necessarily the main trend, but against the short-term trend more often than not. And I always have a stop. Like I advise people, always know where you're getting out before you get in. So that's my trading. Anyway, Fundseeder is a company that was started on the premise that there must be, tons of or many traders globally that are very skilled, but no one knows they're around. They'll never have a chance to manage any money if they want to because they're in the wrong country. They didn't go to a named college. They just. In fact, I got a perfect example in this book. Yeah, a fellow in the Czech Republic. So first of all, Czech Republic. Nobody's going to go. Somebody from the Czech Republic trying to get money to manage. Good luck. Moreover, his education. Forget about going to having a Princeton on your resume. His education ends at high school. So here's a guy who wouldn't have a chance in a million of ever getting anybody to pay any attention to him, no matter what he did. But he's been consistently, doing, making money year after year, almost every quarter, and just a phenomenal return risk numbers. Now he doesn't have a lot of money because he basically never had any money, and he just lives on his trading. But he's trading mega cap stocks, so he could theoretically his approach could be used on billions, but he's trading it on a small account. Anyway, that's a good example of somebody, a perfect example of the type of person we're looking for. Somebody who really had come up with a trading methodology that worked. He's been doing it for like 15 years, and would not have any chance of ever getting discovered. So the idea of Fundseeder is to find these people, providing them with a platform that traders can use to analyze their performance. They can link their account to the broker, which gets updated every day, and then they have an equity curve. They can generate underwater curves, show their drawdowns. They could get all sorts of performance analytics. They could do technical analysis on their equity curve, et cetera, all for free, because what we're trying to do with that part of the company, which is the technology side, is to just build a database of traders, a number of which will be very skilled. And on the other side, we have an investment arm, which has the objective of partnering with major allocators, which we're now in the process of doing, negotiating deals, and then we'll connect. Those allocators can then tap into our database. And so for people who want to get their performance analytics on their on their trading, that's a good spot. Won't cost you anything. And for people who think they have the skill to manage money and don't have the proper avenues, which the vast majority of people don't, this is a way of getting discovered.
That's pretty cool. And when did you start? When did Funseeder start?
Well, the idea was probably about 6 or 7 years ago. First couple of years, was kind of just developing, as the site and stuff. I'd say, but from the time where we had any meaningful number of traders, the fund was operating. We actually had to redevelop the whole software. We initially white labeled another party software. I was kind of unhappy with with everything, and we ended up redoing the whole thing. And so nothing is left from the white label days except for one metric we kept. That's it. That's it. Anyway, from that point on is maybe about 4 or 5 years ago or so.
Huh. So I guess my point is like, I'm surprised there aren't dozens of such businesses. Are there, to your knowledge?
There are, I don't think there's a precise similar site. There are sites which have maybe like trade following sites. There's some other sites that try. I really am not too up on. I just know there are some other people doing not the same thing, but trying to get traders to log on for different ways. But I think our model of basically just providing the analytics to traders and then looking to partner with big name, large institutional allocators to then act as the connector between the trader and those allocators. I think that's different. And we are just on the threshold of that. My expectation is that and we're in currently, I can't mention names, we're currently actually in the negotiation process with one of these entities. And I think if the deal is completed and we can then that news becomes available, and we go from not just being a source of nice performance analytics, but also an avenue to connecting traders with allocation money. I would look for a kind of a real sort of tipping point to use Malcolm Gladwell's what has now become a cliche in a number of traders subscribing, because I think that type of marketing publicity would make people aware we're here and the model has begun to work.
Yeah, I just think it's a really cool idea. And maybe it's just like when the iPhone shows up and everybody goes, "Oh, why didn't we think of this sooner?" It just sounds like a cool idea. But I hope you don't mind me jumping around a little bit. We do have limited time with you.
No, I like that.
Yeah. We've talked with traders and, other people who have written about markets and interviewed traders and things. They all seem to be telling me that trading is harder now than it was, 20, 30, but even like 10, 15 years ago. Do you think that's true?
Yeah. And if you sat me down before I did this book and asked me that question, I would say the same thing. I would have said the same thing. I would have said, well, I wrote my first Market Wizards book. At that point in time, this was forget it was pre-PCs. I mean, you have to do anything, you had to do it on a big IBM mainframe, that type of thing. And so it was a day where, there were not a lot of, there were no hedge funds there were like a small smattering of hedge funds. There was a lot of retail trading and, of course, there's a lot of retail trading today too, but not in the same way. Back then, it was a much bigger. Let's put it this way: the professional traders were a much smaller proportion of the pie than they are now. So I would have said, hey, with the massive increase in computer power, with these firms coming in with literally hundreds of high-powered quants developing methodologies to extract, little inefficiencies out of the market, high-frequency trading, on and on, and this massive growth in hedge funds relative to what it was, it would be much harder for the individual trader to really get any superb type of performance. So yes, I would have said that. And I was surprised when I did this book that the traders in this book, many of them actually have track records which are as good, if not better, than any I've ever encountered. Now, true, they're managing smaller accounts, so it's not like Of course, you can't do if you're Ray Dalio or Bridgewater, managing. I God knows how many billions, 50, I don't even know how much they're up to these days, but I think when I interviewed them was like 50 or 100 billion, some massive amount of money, or even other hedge fund managers trading 10 billion, which is still a lot, massive amount. It's very different maybe than trading, smaller accounts of a couple of million, or in some cases, hundreds of thousands or whatever. So yeah, that's true. But these people have still compiled record. In fact, for one example, one fellow in the book started with literally $2,500 in capital about 15, 16 years ago. When I interviewed him, he had built that up to 50 million. And I just, I'm still in contact with him now. And I just got an email from him the other day, or direct message from the other day, telling me that he's now made 100 million this year alone. And I asked him 100 million cumulatively. He said, no, this year alone. And this is a guy that started with $2,500. So, and in fact, I would say that his multiplication of money kind of exceeds anything I've ever counted. So yeah, there are people in his book that kind of belie the fact that it's not possible to do extraordinary things. Now, he's 1 in 100 million, but so I don't want to mislead people and think they can do that. But the point is, it can be done.
So, but it can be done, but like you say, he's 1 in 100 million. It sounds like you're still saying, yeah, it's really hard.
Oh, well, look, there's a difference between just being profitable on your trading, which is, let's say, a category I would consider myself in, and being a superb trader and having great return risk numbers. So, like I say, I'm not in that camp, but hey, there's nothing wrong with still making money on the markets, right? You don't have, not everybody's going to be a superstar. It's true of anything. I mean, not everybody is going to, you may like playing basketball, but you're not going to be in the pros, right? How many people make the pros? Well, what percentage of people who play basketball make the pros? So it's or any sport or music. I mean, what percent of people, what percent of violin that people who play the violin end up playing solo, for a major orchestra? It's any endeavor. The people who are exceptional are always a tiny percent. So there's a difference between being capable and doing okay, and between being phenomenal. And by definition, it's only a tiny percentage of people that are ever going to be phenomenal.
Right. I guess part of the story here is that, like you say, institutions now, they weren't most of the market before, but now they are.
Yeah.
And basically that's your competition if you're an individual. And, Warren Buffett will tell you it's an advantage to have a small amount of capital and be a small investor versus
he's right,
a bigger one. But it seems to me like folks who are talking about, that's a different approach, though. I'm talking about, like, for example, we interviewed Gregory Zuckerman, the guy who wrote about, the Jim Simons book, Man Who Solved the Market.
And let me give him a plug. His book, The Man Who Solved the Markets, I believe it was.
Yeah.
It's a great book. It's a great book. So, let me plug somebody else's book here. Just an amazing job of getting all these people in a super secretive firm to open up.
I know. Yeah, that was that was one of the main questions that we had for him, and he didn't expect it. He conceived of the project and didn't expect to be able to do it, but lo and behold, and yeah, we learned a lot from that. But I feel like part of what we learned is that, the competition in that type of trading is just like, they're literally rocket scientists. It's literally and that's who you're going up against.
Yeah, well, yeah. So that's a different approach. It's you can't compete at that. You can't compete in that type of trading, right? So you can't. So you're talking about a firm who might have, I don't know, 100 plus, I don't know how many quants they have. And we're not just talking about quants, we're talking about, people with PhD in mathematics who are leaders in their field. We're talking about real geniuses in many of these cases. And you have not just 1 or 10 or 50, and they're all, and of course you have supercomputing power and you have all the support they need and everything else. So, but what they're going to come up with methodologies that are not the type of thing that an individual trader could do, right? So, they're, and I don't have privy to what they do in any way, but essentially, these type of shop, what they're doing is they're looking, they're using scores or maybe who knows, even maybe hundreds of different types of systems, but looking at interrelationships between markets and their derivatives. They might be looking at 10,000 different securities, looking at the relationships between them. And so they're and applying different types of mathematics to it. And so they're just trying to find those places where lots of different strategies which give them a small little edge. Like they're trying to be the casino in 1,000 different ways, right? So it's not that they have one particular strategy, but altogether, all those strategies kind of give them a casino-like result, which is like steadily increasing money without big drawdowns. But it's very rare. Only a few shops that really have succeeded to that extent. And it's not the type of thing an individual trader could do. And the people who do succeed as individual traders, you have to find a completely. That's not the avenue that makes any sense anyway. It's going to be a completely different approach.
Right. Yeah. Oh, in the back of the book, it says you interviewed a trader who made tens of millions using a unique approach that employed neither fundamental nor technical analysis.
Yep.
That is it. Like once you pick up this book, that's a reason to dig into it and find that story alone.
And that was kind of amazing to me, because not only was it an approach that I had never encountered, but it expanded my universe. What I thought was the universe of trading, because all my life, and I've been in the market. I've been involved with markets now, 50 years, right? So I've, I always assume, well, anything anybody's doing, persons could be using some sort of fundamental approach. There could be a million different fundamental approaches, but there's some sort of fundamental approach or some technical approach. Again, there could be a million different technical approaches, or some combination of the two. I mean, what else is there? I mean, you're going to flip a coin, you're going to call heads or tails. You're not going to call sideways, right? There's nothing else. Chris Camilla, this trader, sort of made me realize that, hey, there's a whole way of trading that doesn't use either of those two. And he literally said, he didn't like fundamentals. It was boring. He didn't want to do that type of work. He thought he would never excel at it. There's probably a million people that could do it better than I can, he says, paraphrasing him. He didn't find charts or technical analysis particularly useful. But what he always liked was he always had this thing of spotting trends early. And like he talks about where he used to go to garage sales and try to find undervalued items, and he would ride his bicycle every morning. Before he did this, he would stop for his drink. And now I'm getting a mental blank on what brand it was. But one day he goes and the machine is not there. It's only, it used to be the whole machine, and now it's only like a row or something. Yes, what happened? And a person tells him, that there's more competition now. This is Arizona or whatever. And he went and asked his brother, and he was like a teenager then, 13, 14, I don't know. He asked his brother, who was in the markets or something. He was a broker, and he said, how can I take advantage of this? And this broker tells him about puts. And so he bought puts for him, And so that was his first trade. But he had this, as a child, he had this inclination of spotting these trends. And so what he ended up was both physically spotting types trends like that, but also, but then using social media to amplify this approach, and then analyzing social media like Twitter, and trying to find when there was an increase in traffic in certain types of word combinations. And that would tell him, that there was this new trend starting. So, like, for example, like LaCroix, he asked the waiter, I'm familiar with LaCroix. I said, yeah, we order it by the caseload virtually. And so he said, when first he saw people, and this was when the transition was going from people drinking lots of soda to trying to get off sugared soda and to sparkling waters, different types. And LaCroix which is natural, National Beverage Corporation was the stock. And so they were the first big player. And he saw all these on Twitter. He saw this big spike in people talking about switching to drinking, LaCroix, these flavored waters without sugar, and sort of that was a trade. And so he picks up on these things before they show up in earnings, before they even show up in credit card data. So that's his approach. He uses social media.
Wow. Jack, I feel like you've taken us on a little mini odyssey here from your early beginnings to this sort of weird social media trading idea. But we are out of time. I do want to ask you my final question that I ask all my guests. If you could leave our listener with just one thought today about anything at all, but I imagine it'll be about trading from you, what would that be?
God, oh boy, if one makes it difficult. Basically, well, we talked about risk management, so I won't go to that. I think people sometimes miss what's important, and so if you want, you should go to trading not just to make a lot of money, although occasionally that works, but I think really what's more important, trading is in life, money is in life. It's more about how you live your life. And I've interviewed traders who were phenomenal traders, but I wouldn't want to live their life. They're spending 15, 20 hours in front of the screen, and it's again, you have to ask yourself, is this the way you want to live your life? So I think a balance is important. If you have a passion for trading, if it's what you love to do, great. You can spend enormous amount of hours on it. But if it's just a matter of money, you should not lose the perspective that there are a lot of more important things. It's really about living your life in a more beneficial way, which may include trading, or trading may even be the dominant thing, but only if it really is. And you have to ask yourself, do I really have a passion for this? Or is it all I want to do is try to get rich, and I really don't like this process, and it's interfering with my life?
Well said, man. That's a great final thought. The guy who has interviewed all these traders says, have some balance in your life. I think that's a great final thought, Jack. Thank you for that.
Thank you. Yep.
And I hope you'll come back and talk to us sometime.
Sure, it was fun. I enjoyed it. Yeah, glad to do it when you.
Yeah, me too. I guess that's bye-bye for now, Jack. Thank you so much.
All right, nice talking to you. It was fun. Thanks. Bye.
Okay, wow. I'm so glad that we got to talk to the one and only Jack Schwager. And I meant it, what I said at the beginning about the Market Wizards books. If you have not read them, you are missing something. I would probably have said that, even if we didn't get to talk with Jack, because the lesson, and I keep saying this every time we talk with traders, the lesson of risk management just keeps coming back and back and back. But what's really cool is that, over these 4 or 5 Market Wizards books, there's all different stories. Like you just heard him talking about this guy who trades off social media. There's all these different ways to decide how to place a trade. And yet the real meat of it, the core of it, is about risk management. And so they all come back to this core from different angles. It's pretty cool. To read all the Market Wizards books is a really cool experience. And it's a real cool experience to talk with Jack Schwager too, right? All right. That was great, man. Let's see what's in the mailbag. My colleague and friend Dave Lashmet is on fire right now. His average closed pick this year alone has returned 187%, almost triple your money. Today, he's got a time-sensitive $13 stock pick that he believes is set to explode. This is an opportunity you don't want to miss. Listen to Dave's take along with all of his evidence on the stock over at investorhourtech.com. Check it out. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms, please, to feedback@investorhour.com. I read every word of every email you send me, and I respond to as many as possible. Kind of a light mailbag this week. More comments than questions. There was only really one question. The rest of it was all comments, which is kind of cool. We're just talking, right? So I'll include some of these comments. First one is from Larry B. He says, Dan, in your recent podcast, you were discussing how time is sometimes like an accordion, stretching out or compressing in relation to things changing. It reminded me of the quote attributed to Lenin, Vladimir Lenin. Lenin apparently said, there are decades where nothing happens, and there are weeks where decades happen. I'm going to stop you right there, Larry. That is exactly what I'm talking about. Time just compressed like crazy, and so much happened in 2020 versus most other years. Larry continues, that quote came to me during the meltdown in March and at other times in my life. 9/11, 2008 crash, 1987 crash. Things roll along and suddenly change direction. This year qualifies. Love the interviews, Larry B. Thanks, Larry. Spot on. Perfect timing on that quote. Next is Thomas Y. with our only question this week. He says, how are profit margins, quote, the most dependably mean reverting data series in finance, end quote, per Jeremy Grantham doing, right? So that's Thomas Y. He's asking, how do profit margins look? Because a famous quote by Jeremy Grantham, who I talked about in my rant today, Grantham has famously said, corporate profit margins are the most dependably mean reverting series. And they've been on a tear for some time. They've been quite elevated. And I'll tell you, you can track this, Thomas and everybody else. If you go to the Federal Reserve Economic Data website, FRED, right? It's FRED, F-R-E-D .stlewisfed.org. And you can look around. There's all kinds of data. FRED's a great resource. But this one is corporate profits after tax divided by gross domestic product, right? Over gross domestic product. So this number has been like, there was a peak in 1950 of about, 9.87%. There was a peak in 1979, 8.5%. There was a peak in 2006, third quarter, 10%, 10.4%. There was looks like the all-time high peak of this data series going back to 1947. First quarter 2012, 11.7%. And then, of course, we got a little spike downward, didn't we, earlier this year, right? And it was down to about 8%. But we're skyrocketing right back up. We're above 10% again in the third quarter of 2020. So yeah, we're in an elevated range historically here. So the question is, does this, are things different now or not? And are all these like high margin, low capex type, software and internet businesses, are they just going to pull this up forever? Is it really truly different this time forever? Or is this going to mean revert back into just like the 7 or 8% range on a more long-term basis? And obviously, if it does, then stocks are even more overvalued than they look, right? And Hussman, that's one of his metrics. He calls it margin adjusted CAPE. So he adjusts for the historic margin trends, and he insists that that is the one series that correlates the most negatively with the subsequent returns on the S&P 500, meaning when that thing has been high, 90+% of the time, more than any other, PE or price to sales, the market has fallen. Good question. That's my answer, and you can track it yourself at the FRED website. Mark P. writes in and says, hi, Dan, love to listen to your show about Bitcoin. I knew we were going to get a bunch of these. People still have Bitcoin on the brain. Mark says, about Bitcoin, I think the fear of government ban or intervention in part stems from observing what government has been able to foist upon us during the pandemic. 8 months ago, did we honestly think folks could get arrested inside our homes for having unmasked guests over? Too many people seem to be willing to accept and cower to these absurd directives. It doesn't seem like such a stretch to me that a governmental ban on Bitcoin could be swallowed by the general population, or perhaps just banning large or any businesses from accepting Bitcoin as payment for their services. That still seems like a big investment risk to me. Having said that, however, I must admit to owning some. Keep up the great work, Mark P. It's a fair point. Look, if Bitcoin it has started to work like gangbusters. If it keeps working gangbusters and keeps appreciating in value and makes a real dent in the demand for hard currency in the world, yeah, governments are going to take notice and they're going to try to do something. Chester B is the last one this week. Chester says, Dan, second time writer here, obsessed listener. I'm still hoping you will try to interview Scott Lynn of Masterworks.io about his art investing platform and his view on the art market in the future. As you've said before, everyone should have art in the portfolio. I'm going to stop you right there, Chester. Masterworks.io is interesting. I think everybody should go check it out. Just take a look at it. I don't know anything about it, but I was just kind of browsing around. And it's an interesting idea. I do take issue with the term blue chip art, though. That's a little bit of a stretch for me, unless you're talking about the Mona Lisa or something. But, I did not say that everyone should have art in the portfolio. If you recall, I was talking about Jim Rickards, who I like the guy. I sat next to him at dinner a few years ago, and we had a great conversation. And he has this quote where he says, ask these people in Europe how they preserved wealth over centuries through wars and inflation and all this crazy stuff that happened, invading armies and everything. And they'll say a third, and a third. Land, a third in gold, and a third in art. The gold and the art being portable, and the land in a decent Western developed country, you have good title, you can get your land back even after a war, after the invading army's gone. So land, gold, and art. That's what I said. I didn't say that I know anything about art or that I think you should own art. I said I think you should make investing personal. And you should, if art's your thing, then go for it. If Ferraris are your thing, or vintage guitars, or wine, or whiskey in casks, we mentioned all of these things. Just make it personal is what I said you should do. But Chester B continues. He says, Dan, all caps, you freaking get Bitcoin, my man. Once the light goes off, you become disgusted with people that don't understand what money is. Sure, there's risk, but that's with all investments in today's economic environment. All new forms of money are very volatile in their infancy when weighted against other assets of the time. And then he says he wants me to interview a guy named Preston Pish. We've talked about their program before. It's a pretty cool podcast that I listen to. And then he says, he wants to hear the two of us talk. So that's, I've asked for these suggestions before. I appreciate it, Chester. He says, thank you and keep up the great podcast, Chester B. Well, thanks, Chester. That's good advice, and maybe we'll do some of that. And I'll look into art. I'll look into this whole Scott Lynn and Masterworks.io. I think that's probably a pretty decent recommendation too, it sounds like. If it has anything to it at all, right? All right. Yeah, that's another mailbag, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. If you want to hear more from Stansberry Research, check out AmericanConsequences.com/podcast. And do me a favor, subscribe to our show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. You can also follow us on Facebook and Instagram. Our handle is @InvestorHour. Also follow us on Twitter, where our handle is @investor_hour. If you have a guest you want me to interview, do what Chester B did. Write in, drop us a note at feedback@investorhour.com. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.